So there's a lot of questions out there today. Is the market recovery for real? Is the worst behind us? Or is there a second wave of a market down? Is the volatility going to creep back? What about coronavirus? Where's that headed? What's our economy going to do? Join me along with certified financial planner Jason Newcomer for this month's economic update. Jason Newcomer, certified financial planner here at Barber Finance Group. Thanks for taking the time to share some of your insights on what's going on. May was, by all accounts, an amazing month for the stock market. Not just domestically, but really globally. We saw most markets lift.
Yeah.
Why do you think that is?
I think we're starting to see a lot of the coronavirus cases start to level off. I think flattening the curve has been working, at least domestically in the US. We're starting to see deaths per day decline, which is good news. And there's also been a lot of optimism and hope surrounding some of these vaccine makers and progress that they've shown in their trials.
All right, let's go through some of the numbers on what we've seen happen with the different sectors, because it hasn't been like every single sector has done amazingly well. Some sectors have done better than others. Some of the virtual companies like Zoom and those that did like really, really well during all the stay-at-home orders, those are now falling. And I think a lot of people were piling money into those and maybe at the wrong time.
Yeah, there was a podcast I was listening to earlier today that Zoom's market cap is now equal, maybe just slightly larger than the 5 major airlines combined.
And that's because the airlines have been killed, right? Stock prices are way down, but Zoom's price is up. Now, which one do you think is worth more? I mean, as far as the reality.
Yeah, good question.
And I think a lot of that is going to do with, what's going to be the appetite for travel after COVID-19.
It's starting to tick back up, but still well below where we were a year ago at this time.
Yeah. All right. Let's take a look at the different sectors in the U.S. here. Jason, walk us through this chart. What are we looking at?
Yeah. So this is for the month of May through today. Energy sector leading the U.S. stock market, driven in large part because of the rebound we've seen in oil prices.
We'll get into that here in just a few minutes too. Yeah.
We'll talk about that. And some of the more typical defensive sectors, utilities, real estate, those things have been lagging behind as we're starting to see the economy reopen. We're starting to see the market rebound. So some of the more aggressive names, some of the names that have been hit harder in this pandemic are leading the way back up.
So consumer discretionary, things that people might do, not their normal staples. And so you can see consumer staples at the very bottom of the list. And I think that's because the consumer staples basically held up better than most during the falling of the market back in February and March.
Right.
All right, so let's look at what's happened around the globe.
Yeah, so here's around the world, we're starting to see markets rebound really across the board. But again, the U.S. right here, kind of in the middle of the pack for the month of May, up about 6%.
So when you look at this, Jason, what's this telling you? Is everybody, who's the pink one down here? That's Hong Kong?
Yep, Hong Kong. And there's certainly some geopolitical issues still at play over in Asia. So those countries, China, Hong Kong, down there at the bottom of the pack.
All right, but everybody's had a nice rise. Obviously, all the markets around the globe got hit pretty hard. In fact, I think some of the international is actually down, far more on a year-to-date basis than what a lot of the domestics are, right?
Absolutely. The U.S. large cap stocks are still by far the best performing stocks around the world. Yeah,
and as of today, we're off on the large cap, that being the S&P 500, somewhere around 10% or so. Dow Jones down maybe 14 to 15% through today.
Yeah, so that's off of the highs from back in February. Yeah.
Technology sector's done pretty well. Technology sector is, I think it might be even a little bit positive on a year-to-date basis now.
Yeah, some of those stocks are,
Yeah, so it's been kind of all over the place. At least it hasn't been like an 08 type of a crisis where every single sector and everything just got killed and for a long period of time. Let's take a look at what's happening with federal stimulus. And I think we have to ask the question, looking at this chart here, you're looking at the total assets held by all Federal Reserve banks just going through the roof, right? And all of the stimulus that's been in all the different packages that the government's passed, and now they're talking about another $3 trillion stimulus, which I don't know if we're going to need that or not. I think we're going to have some more time here, another I'd give it another 3 months at least to say before we pass another stimulus bill, because we're getting some good things happening out of the market. But it's interesting, as soon as that stimulus started, that's when you saw the turnaround in the market. So that begs the question, is the stimulus the reason for the market rebounding? Is it the market rebounding because it knows it has the support of the federal government and it can actually take care of that? I don't know if that's the answer, Jason. What do you think?
I think that there's a number of factors at play. I don't think you can point your finger at one thing and say that's the cause of the rally that we've seen from the March lows. But certainly the Federal Reserve was quick to act. They stepped in a big way, and that's had a positive impact on the market.
Yeah, and the reason I don't think that that's the whole thing is because you wouldn't see global stock prices rising just because of stimulus here in the United States.
Mm-hmm. No, and the crisis that we find ourselves in, certainly, a health crisis more so than a financial crisis. Now, it is becoming a financial crisis when people lose their jobs, can't pay their mortgages, can't pay their rents. But you can't just say that financial aid, financial stimulus is going to be the sole reason that we see a turnaround in the markets.
All right, what do we have next? Oil.
Yeah, so oil has had a nice rebound off of the April lows.
We get down to about $15 a barrel.
Yeah. So we're about double that right now as we sit here at the end of May.
Okay, and that, a lot of times when you see that, you think, well, is that a precursor of summer demand increasing? Do we think the travel's coming back in the airline industry, the cruise industry? Are people going to get out and start doing things? Are they going to feel comfortable? Or does this have more to do with the Saudis and the Russians?
There again, I think it's probably both of those things, but probably more so the Saudis and the Russians. Back at the beginning of the year, before the coronavirus was really understood that we were going to have an economic shutdown like this, there was going to be just a drop off of the cliff in terms of demand for oil. We did see the price decline as the Russians and the Saudis were having that price war on supply.
Okay. So we're going to now go to COVID cases per day.
Yep.
So we're seeing absolutely, since what is that, about the 25th of April, a pretty steady decline.
Mm-hmm. Yeah, I think that the stay-at-home orders, the social distancing, not making a political statement here, but they have had a positive impact in terms of the number of cases per day. We also see that in terms of the number of deaths per day. And this is really what flattening the curve was all about. It wasn't to stay home until a cure is found, right? Because we don't know if one will be found or how long it will take to develop that. But as long as the deaths per day and hospitalizations stay low, we see hospitals continue to be able to meet the number of new patients. Then hopefully the deaths.
And I think the vast majority of hospitals are actually struggling on the other side of that, Jason, with they have so few COVID patients, and yet they're not allowed to do elective surgeries and all the other things that make the hospitals money. Mm-hmm. And so you're seeing furloughs of doctors, nurses, and things like that. Mike, I've got a brother that's the CEO of a hospital in Hastings, Nebraska. In fact, I interviewed him on America's Wealth Management show mm-hmm. here a couple of weeks ago, and he has some great insights on that. So I think that it's done a good job of that, but maybe it's a little overboard, and it's time to get people back out and start doing things. And I think that's what we're starting to see.
Yep.
All right, next up here. All right, so continuing jobless claims and the unemployment rate. I mean,
staggering.
These are numbers that are off the charts.
Yeah.
So we're sitting at a 14.7% unemployment rate,
yep.
which I don't think we've seen that since the Great Depression.
No, yeah, these are numbers that we've not seen in any of our lifetimes.
No. Now, here's what I think. So let's just put it out there that 47% of people who work in the United States work for small businesses. Mm-hmm. All right. So one of the things, I think the best thing that was passed in the CARES Act was the Paycheck Protection Program, mm-hmm. where they gave these small businesses loans that would be forgiven if by June 30th, they can show that they still have the same number of employees at their company as they had when COVID-19 started. Mm-hmm. So there was an application process that they had to go through. I think a lot of these small businesses are going to be hiring people back in very rapid fashion. And I think when we come back at the end of June, that we should see a really significant drop in that unemployment rate. That's my thoughts.
That's the hope. Yeah, that's certainly the hope.
Yeah, but with a caveat there is these small businesses, if they don't let anybody go and they spend the money the way that it's supposed to be appropriated, that actually becomes a grant and the loan is forgiven. And I think that'll help a lot of these small businesses stay in business, and it'll keep them in the ability to continue to have the same employees and get those people back to work.
One of the things that's interesting, though, when we look at unemployment and we look at these numbers and you think, how in the world can we have numbers like this come out month after month, week after week with the initial jobless claims and have a market that's rallied more than 30% since the March lows?
Right. I think it's interesting. Well, our next chart is going to show you 2008, the financial crisis. And so walk through this chart for everybody, Jason.
Yeah, it's interesting. When you talk about unemployment rate and jobless claims, those are considered lagging versus leading economic indicators. So they're looking at things that took place either last week or over the last month, not necessarily what the market's looking at all the time. So when we go back to the financial crisis and we're looking down here, the market bottomed in March of 2009. Well, over that time frame, unemployment continued to rise over the next several months. From March of 2009 through the summer of 2009, another 1 million people lost their jobs. But over that same time frame, the market rallied about 50%. So we saw something similar happen at totally different scales, right? We're talking about 1 million people over the course of 3 months back in 2009. Where now we're getting almost weekly 2 to 4 million people every week are filing for unemployment.
I think the interesting thing is that the stock market does tend to look ahead, right? I think it was easier for the market to look ahead there in 2009 than it is today, because with the uncertainty that we have over COVID-19, and the biggest uncertainty, I think, is how quickly are people going to get out and resume that normal activity, right? And how 70% of our total gross domestic product is consumer spending. And so unless that consumer's comfortable to get out and do things, I don't think we're going to see the GDP numbers get back to where we need them to be. And in fact, I think it's going to be almost impossible for companies to forecast their earnings. And the stock market's usually saying we're looking at these forward-looking earning projections for these companies, but there's, what did you tell me before we did this, 30% are not even going to forecast?
Yeah.
They suspended guidance?
Yeah, FactSet had a report where they looked at quarterly earnings calls, and of the 474 companies in the S&P 500 that had these calls, about a third of them had said, we're suspending guidance for the remainder of 2020. So they don't even know what's going to happen.
No, they have no idea, because again, the caveat, the big, 10,000 pound elephant in the room is, what's the consumer going to do? And I think that we will start to be able to see that over the next couple of quarters. We'll start to have a good idea of how comfortable people are getting out and doing things and getting back to that normal life. And the market seems to be indicating that people are just going to get right back out there and do it. Yeah,
but to your point, I don't think that we're in the clear yet. If there's a second wave of these, virus cases or deaths that crops back up, whether it's due to people relaxing on their social distancing over the summer, or maybe it's more seasonal in the fall and winter, we see that second wave. Certainly, we're probably going to see some more volatility in the markets.
Yeah, I don't think the volatility is gone, for sure. I mean, again, I think there's going to be surprises, and those surprises are going to continue to come at us pretty much on a weekly, monthly basis at the very least.
Yep.
All right, so there's your market year to date. 3,200 to begin the year, 3,000 now. Still a negative year, but far off of the lows. And many people would say that this is setting up to be a V-shaped recovery in the markets. And if it's a V-shaped recovery in the markets, that's telling us that it should be a V-shaped recovery in the economy.
Yeah, you almost have to have two separate discussions when you're talking about the markets and the economy today, because those two things seem to be not on the same page at all.
No, they're not.
Yeah.
No, they're not, but the markets are the leading indicator. So the markets are telling us that. Or could we be in a W, right? So where we have a wave up and then another wave down, retest those lows, and then finally come out of that, which is more traditional. I think the most distinct V-shaped recovery that we've ever had in the market was the October 19th, 1987
Oh, yeah.
23%
absolutely.
loss in a single day, right?
Yep. Yeah, we had a V-shape. I guess you could call it a V-shape recovery back at the end of 2018. Where we saw the markets decline by about 20%, and within 3 months, we were back to where we were.
Yeah.
And I think if you were to ask, if we could somehow do a poll of the viewers of this video, and we'd say higher or lower, over the last 12 months, is the S&P 500 higher or lower? Is it in positive territory or negative territory? It's actually up about 6% over the last 12 months. And the level that we're at today, as of the shooting of this video, the market hasn't been at this point, I think mid-October last year.
Right. Now, that's the S&P, right? But you take the Dow, it's in negative territory, right? The small caps, negative territory, big time.
Absolutely.
Big time, right?
Yeah.
International, negative territory, big time. So the thing is, when people have a diversified portfolio and do it the way you're supposed to do it, they're not seeing their performance match the S&P. They're probably outperforming the Dow. They're outperforming the small caps, but they're underperforming the S&P 500. But that sometimes is the nature of the diversified portfolio.
Absolutely. When your portfolio is diversified, you could always have something to complain about in terms of the return. There's always going to be something that's being a drag on the performance. But
that's the smartest way to do it.
Absolutely.
And it's proven time and time again that that's the smartest way to do it, not to get too concentrated in one single area.
Yep.
All right, we got. Let's talk about GDP falling off a cliff.
Yep.
Right, and we've never seen GDP drop that fast. But again, it was the stay-at-home orders. Everything got shut down. Right?
Yeah, the economy shut on a dime.
Yep. So it'll be interesting to see what second quarter GDP comes in overall. We should have some preliminary numbers on that. We won't have them at the end of June, but we'll have them at the end of July. We'll have some preliminary numbers on second quarter GDP. But I think it's going to be ugly. I think it's going to be far worse than what we see here at the minus 4.8. But again, the market would be telling us that those GDP numbers are going to turn around when these stay-at-home orders go away and people get out and start spending again, that GDP should start going up.
Right.
All right, let's talk a little bit about bonds. 10-year treasuries down at 0.66%. And we had a time frame where the 1 and 3 month treasuries actually went negative. And I think the Federal Reserve made a comment here a few weeks ago that they're going to keep interest rates at zero until we get back to full employment. Okay, so full employment is going to be that 4.5% to 5% unemployment rate. So I think we're going to see, continued low interest rates, which that is a problem for people who are trying to get interest or yield on their investments, right?
Yep. Yeah, the big problem there is you've got people that will need that yield, need that income on their portfolio, but you can't get it in safe instruments like U.S. Treasuries. So they'll expand out to riskier assets in search of that yield.
Yeah. And sometimes those can be rewarding, and sometimes they can be kind of ugly.
Yeah. If you were overexposed to those assets in the first quarter, you certainly felt that in your portfolio.
No doubt about it. All right. So one positive thing about the low interest rates is we're seeing a huge demand for home buying.
Yeah. Good time to be refinancing.
Yeah.
But
the first-time purchasers are up substantially. I mean, we've seen a huge rebound in the housing demand. So I think there's some bright spots out there. I would caution people to not get too optimistic and say, hey, the worst is definitely behind us and smooth sailing ahead, because I do think there's going to be some volatility out there. But I think the critical thing, Jason, as we always tell our clients, is this: make sure that your portfolio fits in with your overall financial plan, right? If you're not comfortable with the level of risk that's in your portfolio, have a discussion with your advisor about, should you adjust that? What's it look like? And if you do, what's the trade-offs? But keep that line of communication open and try to understand exactly what's going on.
Absolutely. Now that we've rebounded off of the lows in March, if you didn't make any changes to your portfolio yet, this is a good time to reassess how much risk is in the portfolio. What was the experience like for you in February and March? How has it been since then? And have a meaningful discussion about risk in your portfolio and tie it into your financial plan.
All right. Well, thanks for joining us here, Jason. Thank you for being part of this month's economic update. And as always, we encourage you, keep the lines of communication going. Stay in touch with us. Call us with any questions. We're here for you, and we wish you the best and stay healthy. For all of you YouTube viewers, hit the subscribe button, the bell icon, and share this with your friends.